Welcome to the video on low-risk trading using Technician software. When deciding to buy or sell a security, it is easy to overlook a very key component of the trading decision, risk versus reward. If a market is in a bull trend, selling the top of a corrective phase for short-term trade may seem prudent. However, if the downside potential profit is 3 points, for example, and the upside potential loss, if wrong, is 10 points, the trade simply does not make sense. Technical analysis can help analyze the risk-reward potential as well as point out immediately when a good trade goes bad. Well, what is a good trade? A few trend lines in the chart can identify when trading is excessively risky. For example, this is a daily chart of Starbucks and shows a rising trend channel in early 2015. In April, the stock got a bit ahead of itself on a gap up to resistance at the top of the channel, and then it fell back. The question was whether it was a good idea to buy that dip. The answer in this case was yes. Although not as clear then as it was later, the rising trend was solid. So was support at the horizontal line shown. Therefore, when the stock formed a bullish reversal off that combination support, it was a good risk to buy. And that would be right about there. The risk was not of being wrong, as that is always present. The risk was how much could be lost if the stock headed lower instead of higher. And where was that point? A reasonable stop could have been just under the support line and also below the channel bottom, perhaps 1.5 points below that. So was that good? It depends on the amount of profit we believe possible if the trade went the right way. In this case, we would have expected the stock to at least reach a new high within the channel, and more likely a higher high more than 4 points above the close of the reversal day. So perhaps in this area, although that might be aggressive given the time frame. Eventually it did get there. So in this case, we would have a reward to risk ratio. Notice I said it reward first. Ratio of 4 to 1.5 or 2.6 to 1. Anything above 2 to 1 is considered worthy, with 3 to 1 being even better. And considering there was no resistance anywhere close, we had to think the reward to risk ratio was even better than we calculated. It was indeed worth buying. This next chart is an hourly of the S&P 500 ETF, or SPDR. We can see a nice band of support and resistance here. On the right side of the chart, the rally seemed to stall, and other indicators showed weakening momentum. Therefore, selling the ETF at that resistance level would have been a low-risk proposition. And again, low risk if wrong, not low risk of being wrong. However, we can see that the ETF did punch through, and it would have been stopped out immediately at perhaps, say, 200 even from the line, which is drawn at about 199.5. So the loss would have been small. But if the ETF did indeed start to sell off when it reached resistance, it had a good chance to reach the lower support, and that's just over a price of 197 for another good reward to risk ratio of 2.2 to 0.6 or 3.6 to 1. This particular trade did not work. However, the risk was prudent and the loss was kept to a minimum. So the key to being able to follow an aggressive yet low-risk trading approach is to be able to be wrong without going out of business. Taking a 100-point risk to make 300 is a good bet because it enables us to be in the market before the big breakout moves occur for maximum profit. The saying, ride the winners and cut the losers, really means that for every big winning trade, there are several small losing trades. Just like in baseball, a 400 batting average will put us in the top of the game and make us very successful.